CFTC paves way for crypto's trillion-dollar offshore trade. The leverage shift starts now. Here is the signal that separates noise from actionable change. We will map trigger, incentive shift, and downstream impact before the close. That's the scale of cryptocurrency derivatives trading that just got a regulatory green light from the CFTC. 3 weeks ago, this wasn't possible. Today, it is. And the downstream effects are already moving through the market. Let's start with what actually changed. The CFTC, that's the Commodity Futures Trading Commission, just clarified the regulatory pathway for crypto-linked perpetual futures to trade offshore, completely offshore, without the traditional onshore custodial requirements that have slowed crypto derivatives for years. Perpetual futures are leveraged bets on crypto prices. They're designed to never expire. Traders can hold positions indefinitely, rolling them forward. They're popular because they're efficient capital vehicles. You can trade $10 million in notional exposure with far less capital locked up. For context, major crypto exchanges like Binance, Bybit, and OKX have been operating these products in legal gray zones or partially regulated jurisdictions. The CFTC's move doesn't make them explicitly legal in the United States, that's important, but it removes a category of enforcement risk. It signals that offshore crypto derivatives are now within the bounds of how the regulator thinks about the market. That signal is worth billions to market participants. Now here's why this matters to creators, traders, and investors. Liquidity just got cheaper. When you reduce regulatory uncertainty, you reduce the risk premium that exchanges and brokers charge. Tighter spreads, lower borrowing costs for leverage, faster execution. The offshore crypto derivatives market is now on a clearer trajectory toward becoming a core venue for institutional money. And institutional money is what turns a speculative asset class into a tradable market infrastructure. But there's a second layer here that nobody's talking about yet. The CFTC's move implicitly acknowledges something the agency has been dancing around for 3 years: crypto derivatives trading will happen offshore regardless of U.S. regulation. Instead of fighting that reality, the regulator is essentially saying, if you're going to do this, do it in a way that doesn't mess with our onshore financial stability. That's a tactical retreat, not a surrender. It buys the CFTC time to build domestic crypto derivatives infrastructure while accepting that the cutting edge of leverage and notional volume will happen outside U.S. jurisdiction. For creators in the crypto education space, this is a turning point. The sophistication of your audience just shifted. 6 months ago, perpetual futures on offshore exchanges were a niche product for advanced traders. Today, they're on a path to becoming the primary venue for crypto volatility trading. Your content needs to follow that migration. Tutorials on Binance perpetuals, risk management for leveraged positions, basis arbitrage, this is where attention and credibility are moving. The beginner content is still valuable, but it's not where the growth edge is anymore. Here's the contrarian angle: this move could actually slow down spot market adoption in the U.S. When derivatives are cheaper and more liquid offshore, retail investors have less reason to hold spot crypto on regulated U.S. exchanges. They'll trade leverage instead. That's bad for companies like Coinbase and Kraken in the short term. Their spot volumes could face downward pressure as capital migrates to leverage trading. But it's good for their future services, which most of them operate offshore or plan to expand. It's a shift in where the profitable business actually sits. Looking ahead, 3 things to monitor over the next 30 days. First, watch whether major U.S. institutions start announcing partnerships with offshore crypto exchanges or building crypto derivatives desks. That's the signal that institutional adoption is accelerating. Second, track whether the CFTC gets pushback from Congress or other financial regulators. A single comment from Treasury or the Fed could reframe this entire move. Third, watch crypto volatility. More leverage available equals more volatility. If we see a 40 to 50% swing in Bitcoin or Ethereum within weeks, that's not coincidence. That's leverage being deployed at scale. The bigger picture: this is part of a larger shift in how regulators think about crypto. Instead of banning or heavily restricting it, they're carving out zones where it can operate with more freedom, as long as it stays offshore. That's a win for market participants. It's a signal that crypto derivatives are here to stay, and the fight now is about where they happen and who controls the rails. This is worth paying attention to. If you trade crypto, educate about it, or invest in the space, the cost of capital just dropped, the regulatory timeline just compressed, and the game is moving faster. Subscribe for daily intelligence on markets, crypto, and the systems reshaping how capital flows. And watch the next 30 days closely. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.